Good morning, everybody. I am Marina Parkin of Koontz and Parkin CPAs. Today is Tuesday, July 13th, and I'm joined here today by my partner, Jackie Durham. She's the attorney at Koontz and Associates. And today we are bringing you part 2 of rental property extravaganza, if you can call it such. This is a continuation of part 1, and just for your reference, part 1 was done and recorded on December 15th of 2020. Jackie, can you believe it's been that long?
It's all a haze, yeah.
We kept wanting to come back and talk about the rest of the rental property implications, and there's always some interesting subjects to bring along. So I thought I would refer to the original recording so you guys can come back and listen to it. And I got to be honest with you guys, I actually went back and listened to it myself this past weekend just to see where we ended and what I promised people I would touch base on. And good God, after listening to myself talk for an hour about rental properties, I'm not sure why anybody would be joining in today.
Oh, stop.
So I have a pretty clear picture of what we wanted to cover today. So the way that we had structured our conversation about rental property was to talk about it in stages. It was to talk about purchasing it, owning it, and then selling it. So we talked at length about how to buy it and the implications of owning it in a certain type of legal structure and the importance of legal liability protection. So you can listen to all of that in the first part. And then we got into what to do when you're now the owner and you're renting the property. So we talked about income, we talked about expenses, we talked about what type of income to recognize, what type of expenses are deductible. So we covered in pretty good detail all of that sort of stuff. Where we really ended was touching on vacation rules. So before we get into getting ready to sell the rental property, I wanted to wrap that up. And I also wanted to touch on a subject of, okay, now we have a rental loss. Can we take that deduction and who can take that deduction? And once we cover that, then we can move on to the selling of the rental property. So all of these subjects, as we mentioned before, we can talk about for weeks and hours at a time. So my goal today is just to sort of highlight the importance of these areas and specify that each situation is very, very particular. And if you want to talk to us about your specific situation and to see what applies to you, please call us, schedule an appointment. If you already have a CPA, please talk to your CPA. This is extremely important. Not all of it is very black and white, so it really will depend on the factors that are relevant to you. So just to wrap up our conversation on vacation rental, the idea here is that if you own a home, which you are using both personally and for rental, is that you have to prorate the rental expenses. So if you have to look at the use of the property personally versus business. Generally, the idea is that if you own a property, let's say it's your principal residence even, and you go away on vacation, you live in a great area, and people want to rent it for maybe a week or maybe 2 weeks at a time. Aside from the fact that if you rent it for too long, you can jeopardize your homestead, which Jackie can close her ears and not listen to it. But the idea here is that if you do rent any of the resident, even if it's your vacation home, if you rent anything for less than 2 weeks, less than 14 days, you don't even have to declare the rental income on your tax return. And on the flip side is you cannot take any expenses against that rental. So you can still take the expenses that are normal expenses, such as your mortgage interest and your property tax on the itemized deduction schedule. But essentially, you cannot deduct any of the other expenses because you're not going to include income. Now, if you're renting your property for more than 14 days in the year, this is where the fun begins of allocating the deductions. So the idea here is that if you're renting your house more than 14 days, you got to look at the total expenses relating to the property, and you have to come up with a reasonable formula of how you're going to allocate these expenses to the rental. The other part that can limit your expenses, generally speaking, is that if this in fact is your principal residence or your vacation home that you personally use for more than 14 days or more than 10% of the number of days that you're actually renting that out, is that you cannot deduct more expenses than you generate rental income. So essentially, you're still showing that rental schedule, but you're going to zero out. Now, those expenses are not entirely lost. You can carry any unused expenses forward. So it's still just as important to actually sit down and figure out how to allocate those expenses between the personal and the rental, and anything that's unused is carried forward. In the case where you're not using the property for, like I said, more than 14 days or more than 10% of the fair value rental days that you're actually renting it, you don't have that limitation on not being able to deduct more expenses than you have income. So you can create that rental loss. However, your next stage is being limited by passive activity loss rules, because most of the cases, if it is a property that you also own personally, you are likely not a real estate professional. We'll get into that in just a minute, but you're still going to have a loss which may be disallowed. In any case, that loss can also carry forward. So you, again, it's just as important to figure out the calculation of that rental loss, even if it is partial ability to deduct expenses, because what happens is, if next year or the following year, you turn around and you actually make profit from this rental, for example, it's in a great area and you've got some great Airbnb bookings and it's a vacation rental and you're able to charge quite a bit, now you're actually turning profit, you can use these carry forward expenses from prior years against the rental income and able to wipe that out. Or alternatively, in the year when the property is sold, you're able to claim any unused expenses that have been carried forward, as well as any of those losses that you've had to carry forward. So those vacation rental rules can definitely get pretty hairy. And you hear a lot of times people say, well, I have a vacation property in North Carolina, it's a home in the mountains, but when I go up there, I don't count my personal use days as personal use days. If I'm in there, I'm renovating, I'm working, I'm doing that sort of thing. And these are all great strategies to try and minimize your personal use days so that you're not limited to the amount of expenses you can deduct. But again, we have to be reasonable, and it's got to have a sort of a proper business use, and it has to look reasonable and necessary in order to run that rental property when it comes to you doing the work on the house. So like I said, it can get pretty interesting and not exactly clear, but so I just wanted to highlight to you that it is a concept out there. It does require quite a bit of calculation. And if you are interested, or if you are in that situation, or you're considering purchasing a second home, which you want to rent out and want to see how the deductibility of those expenses will work for you, please give us a call. Let's schedule an appointment. Let's run your particular numbers through and see how that's going to look like. So that's one issue. Anything else, Jackie, on vacation rentals? I know it's not, this is definitely more of the tax calculation, but in case something jumps up at you, I want to hear your thoughts.
Yeah, no, I think in the last webinar, we just touched on how important it is to make sure you have a good agreement in place. And a lot of, if you're doing a vacation rental and you're doing it through like an Airbnb or something like that, a lot of times they can supply you with form rental agreements, but I still recommend that you get those checked out, because sometimes there's unintended consequences. It might look like it's covering everything and it's not. And then you don't know until you run into an issue, and then it's too late to go back and rework that rental agreement. So, that's important too, especially for vacation rentals.
Yeah, absolutely. Yes, and people tend to forget that. And I think that if you do have an Airbnb, at least that can sometimes prompt you to, oh my God, I need a rental agreement. But if you're just doing it personally, and it may be family or friends that are coming to stay with you, you still are going to benefit from having some sort of an agreement that will cover you and also outline your responsibilities and their responsibilities. So absolutely that. And
if I can just make one mention of one more thing, because I personally, I know like there are a lot of families that do that where they have a family home on the beach or in the mountains or whatever, and the family members, the various family members will reserve time, but they're also bringing their drunk friends with them.
Yep.
And you need to keep in mind that everybody goes away, they have a good time at your vacation house. It's been in the family for years, and you don't really think of it as a rental, and you don't really think about the liability that comes along with all the foot traffic that's going through there, even though you're not marketing it as an actual rental. So having a good insurance policy in place, and more importantly, having a good umbrella policy in place is something else I'll mention, because I've seen that happen a couple times where, you might have it underinsured, or it might just be an afterthought because you don't really think about it as a business. It's more of like a family establishment. But the problem is, even though it's just family using it, they're bringing in a lot of different people. And so that's just my thought there.
Absolutely, Jackie. Thank you. That's fantastic. So the next topic that I wanted to cover is, again, wrapping up the owning of the rental. And actually now we have a loss. So we've discussed our rental income, we've discussed our expenses, we generated a loss, which is very, very common, particularly in a residential rental situation. I see once we have the depreciation expense and repairs and maintenance and a lot of those allocated travel expenses, we come up with a loss. Now, what do we do with this loss? Well, the answer is it depends. And this is where we get into this super, super gray, complicated area of passive versus active versus real estate professional. So I'm going to mention a couple of things here, and then we will move on to selling it. But I wanted to let you guys know that it is, I talk to a lot of my clients with rental properties about this all the time. This is all depends on facts and circumstances and very particular to your situation. And this changes literally year to year, depending on where you are in your life and how the rental figures into your income generating activities. So let's start with saying that this rental property is passive to you. In fact, anytime there's a rental, by IRS rules, it defaults to being considered a passive activity. So what happens is when the activity is passive, you get limited to your ability to claim these losses. What happens with the rental loss, if the activity is passive to you, is that the loss carries forward. And remember what I just mentioned about the vacation rental loss? It works in the same way. So the passive loss carries forward, and it can be used in two situations. One is when you actually potentially generate positive net income in next year, the year after, and so on. And it carries forward indefinitely. There's no time limit. Or when you actually sell the property, and in the year you sell the property, all of those passive rental loss carryovers open up and can be deducted in that year. So when you're trying to figure out your rental income and your rental expenses, and people say to me, you know what, I'm not going to get this loss anyway. And so like, yeah, it was about $1,000 in repairs and $2,000 in insurance and so on. It's just as important to work on the calculation of that rental loss in any particular year, because trust me, 10 years from now, when you go to sell this property and look at what's happening this year, you're getting a big gain from the sale because your property is valued higher. Now you wish you had all those passive rental losses in your back pocket to be able to utilize against the gain. Now, if you don't calculate those rental losses and put them on the books, essentially on your tax return as a carryover schedule, IRS is not going to take those. So if you're filing a tax return this year and you're showing the sale of your passive rental, you then say, oh, you know what, I've had a loss of about 30 grand in the last couple of years. No. You got to go back. You have to file amended returns for all the years that you've had this rental to establish the loss, which then you can take against the gain from the sale. So the loss has got to be on your tax return as a carried forward item, and that is the only way you can use it. And I cannot tell you how many times we've gone back and amended years and years of tax returns to really establish that rental loss properly to be able to use it against the gain. So this works in the situations where you are where this rental is a passive activity to you. What does that really mean? That means that you may still be doing some work for it, but very, very limited, or it's in a different state, or you have a regular normal job and you're not really involved. You may have a management company manage it, or you may put one tenant in there and never talk to them again until it's time for them to move out. So that really is passive. So you're not really involved. The next level of participation is called active participation. Again, very, very gray area. With active participation, you do need to make some management decisions relating to this property, and you need to have at least 10% ownership in this property. So if you own a rental with a bunch of your friends, or maybe your family, or maybe you're a partner in a partnership that owns it, you've got to have at least 10% ownership in the rental property and make some management decisions to have active participation. What does active participation give you? Active participation allows you to deduct up to $25,000 of the rental loss in any given year, only in situations where your net income does not exceed $150,000 for a married filing joint, and I think it's $100,000 for single filer. So I always tell my clients it works very counterintuitive in the sense that when you have more income is when you really need your rental loss. But unfortunately, the more income you make and you go over 150, that active participation loss still, it disallows that loss. So you cannot take the 25,000. And that 25,000 rental loss that's allowed does get kind of phased out when you get closer to that 150,000 of adjusted gross income. But it's also a nice way to track the rental loss. So you may be able to take some rental loss against all of your other sources of income, and then you may still have some of that loss that's going to be considered passive and again carried over. It's extremely important on the tax return to track it in the different ways. So if I generated, let's say 35,000 of rental loss, and I was able to use 27 of it or 25 of it, then the rest of the 10,000 has to carry over as the passive loss. So you've got kind of these two different schedules. And, there's always a joke in the CPA world that if you have a rental property, you better stick to the same CPA until you sell it. Because when we roll over the tax returns is when all of that carryover rolls properly. If a CPA takes over for another CPA, or even worse, for a TurboTax preparer, we may not have all of the proper carry forward amounts from before. So when I take over, just because we have so many people with real estate, my ears are perked up to where's the passive loss carryover schedule, where's your rental income schedule, were you able to take rental income? And if I see that they were considered to be active participants, I always ask why. Tell me again about your facts, because sometimes the CPA doesn't ask and they just assume you have active participation. But there's definitely, again, it's a gray area between passive participation and or just no participation and active. So what does that mean? Make some management decisions. So there's some guidance that's given by IRS, again, very specific to situation, to your particular circumstances, but nonetheless, you can move on from passive to active. And then finally, it's what everybody wants to be to claim the loss, is a real estate professional. Now, real estate professional, as just a dictionary definition, is probably a little bit different than what is a real estate professional for IRS purposes. So in order to be a real estate professional for IRS purposes, you need to pass a couple of different tests. Number one, you need to have at least 750 hours in the year in real estate activities. Now, the nice thing is that you can actually group your real estate activities, and it doesn't have to be 750 hours spent on this particular rental. If you're also a realtor, those and you're generating commission, those hours also count. So you're able to make an election. Now, that election does have to be made on the tax return, but you can make an election and aggregate all of your rental activities together. So stay with me here. We got 750 hours in real estate related work. That's test number one. Test number two, more than half of your activities that are income producing activities in the year have to be real estate related. So you may have a business, you may have a job, you may have a side gig, you may have a weekend warrior project, anything that you do in the year to make money. So it's got to be your activities that you generate income from. More than half of them have to be real estate related. Okay. So most often, again, the IRS is going to look at the hours. So if you've got a full-time job, and a full-time job is considered 2,000 hours in a year, it's really hard for you to, even if you say that I spend 750 hours doing real estate stuff, that 750 hours and a 2,000-hour job that is not real estate related whatsoever don't compute as 50-50. Okay, does that make sense? So you are really looking at half of the activities that you spend in the year, and you can use your hours as a guide, have to be real estate related. We'll get into the hours again. We'll come back to the hours because you're kind of looking at all these different factors at the same time. The last thing that you really need to look at is the activity that you're trying to say that you are a real estate professional in, you materially participate in. Okay, so the material participation is yet another guideline to IRS to say that you're not just working in a real estate sector, you're also materially participating in real estate activities. So it means that the real estate activities are in the normal course of operation for you. You're making management decisions. You have a lot of the hours put into that activity, and you've got some ownership and you've got say in what happens. And IRS has a couple of different tests. So just kind of to give you an idea, I pulled up some stuff to give you guys as a guideline. So they're looking at 7 different participation tests. So one of them is that you've got your hours, and so you need to have about 500 hours. The other test is that the activity has to be you have a continued participation. So it's not like, well, I do a little bit of this work and then I stop. So you're continually participating in it. You also have to have, let me see some other good things in here. The activity has to be also regular. Again, they're just looking at sort of your pattern and your intent in what you do daily. And then the other extremely important part here is that you may have a job in a company that does real estate. So you're not a realtor who generates their own commission. You may work in a brokerage as maybe an assistant. So you're just a W-2 employee in a company that does real estate, or you work for, say, a property management company. You've got a full-time job. You having a full-time job in a real estate sector by itself does not give you those hours because you don't have what's called material participation because you do not own this company. So you don't really have any skin in the game. If you own at least 5% of the entity where you also work, that changes it completely. So if you've got, again, 5% of the ownership of the company you're working for, in that case, you can claim the hours that you work there as an employee as well as the hours towards you, or both the 750 hours, the material participation hours, and also the hours of how many hours in the year do I have towards the real estate activities. So all of that kind of has to come together. It's like the stars have to align for you to be considered a real estate professional. For all our realtor clients, of course, it's a no-brainer. They're all considered real estate professionals. And with them, we're able to aggregate their real estate activities to say, hey, I'm a realtor here. So I've got this, my real estate income. I also have a rental property, even though in that particular rental property, they may have a management company that's managing it, but we're able to make an election and aggregate it so that the loss from the rental property can be used against the income from their real estate commissions. And this is fantastic because ultimately this is what everybody wants. Everybody wants to be able to use the rental loss without limitation, without carryover, without any issues in allocation and proration against all of their other sources of income. Very important point here before we move on is that if you're filing jointly, only one of you has to qualify as a real estate professional, so that you're still able to use the rental loss against all of the other sources of income, as long as one spouse qualifies to be a real estate professional. So that's very, very important. So we always joke that people say, well, how do I reduce my income? I make so much money. And we always say, marry a realtor. So, it's true. It's true. Now, the realtors nowadays are making more money than anybody else. So I don't know that advice really sticks, because now if you marry a realtor, that may push you into the higher tax bracket. But the idea here is that at least if you've got a rental on the side, now you can claim that to be, an unlimited rental loss use. So this is really all I wanted to talk about in terms of being able to claim rental loss. And I wanted to move into kind of selling our rental. Jackie, any thoughts before we get there?
Well, I certainly have some thoughts on the sale of a rental property. So if you want me to start with my legal side of things, and then you can wrap up with the tax side. So just some considerations that I think everyone should make. I know I've harped on this in part one, but I think having a good, well-written lease in place for your rental property is first and foremost the most important thing you can do, because when you do go to sell, the lease should have certain covenants within it that require your tenant to cooperate in the event you go to sell, or in the event you refinance and you need them to sign some kind of like subordination. You want to have those parts of the lease in there to make sure that you gain the cooperation you need should the time come that you go to sell your property. So that's first and foremost. It's also more attractive to a buyer. So if you have a buyer coming in to purchase your rental property, if there is a good lease in place, that's going to be more attractive rather than there not being a good lease in place, because now they have to find a way to get this existing tenant to sign off on the lease that they want them to sign off on. They have to pay an attorney to prepare the lease. It's just less attractive. So if you make it, easy for them, that's your best case scenario to capture as much interest in your rental property as possible. The other thing I think is really important is to know your market, because depending on where you are with the particular lease that you have on the rental property, if it's a longer term lease or a short term lease, you need to look at what kind of market there is for this particular property. If it is something that is going to attract more rental investors, then keeping the lease in place is probably your best bet, as long as the tenant is performing well under the lease and they're an attractive tenant. If you are going to be selling what has served as a rental property for you, but that could otherwise be very attractive to home buyers, you might want to consider A, the balance of the term that's left on the lease, how much longer the tenant's going to be there, and B, you also want to consider possibly negotiating an early termination of that lease, because it's going to expand the pool of buyers that you can attract. Because if your property can serve as both a rental property or a home, you don't want to turn off home buyers by having a tenant in place, which that will spook certain buyers, because not all buyers want to come in and assume a tenant. So you want to keep your options as open as possible. And I think that's also why it's so important to work with a good real estate agent, because they're going to be in the best position to examine the market around you and let you know what you can do to expand the pool of potential interested buyers as much as possible. So taking a look at that is really important. Also knowing the circumstances with your tenant is extremely important. I've seen bad tenants kill deals left and right, and it's really important that if you have a tenant who's not performing under the lease, or they're unresponsive or uncooperative or just difficult in general, that's definitely a tenant that I would strongly consider trying to negotiate an early termination of their lease with, because that 100% can jack up your deal. Most contracts call for tenant estoppels, which is basically a document that the tenant signs confirming the terms of the lease and that everything's in good standing. That's a deliverable typically under the contract. So if the tenant is being uncooperative or unresponsive and they won't provide that, your buyer can terminate the contract and walk away from the deal. Also, if you have a tenant who's not keeping up the property well, isn't being cooperative with showings, isn't leaving the home during showings. That can also really hinder your ability to sell the property. So while you want to continue that rental income coming in, if you don't have a good tenant, that could ultimately delay your ability to sell and kill your deal. Now, if you do have, on the flip side, a good tenant who is cooperative and responsive and has performed well, by all means, keep them in place if you think that you're going to have a decent pool of rental buyers coming in. But what I would also recommend is just to make your property as marketable as possible, is to maybe cover the cleaning expenses and the landscaping expenses for the property during the listing and pending period of the contract, or offering your tenant a credit to incentivize them to keep up the property and to be cooperative with leaving for showings and things like that. I think being kind and considerate to your existing tenant will go a long way in gaining their cooperation if you intend to allow the property to convey with the lease in place, or in the event the tenant is unwilling to negotiate an early termination. So, and again, the last thing I want to mention is just making sure you have a good agent in place. I feel like there is a lot of folks out there who are trying to save on commissions right now, or in general. You know, there's plenty of folks that they see that 6% or that 5%, and it spooks them a little bit. But what I think a lot of people overlook is that the expertise that a real estate professional brings to your transaction, statistically, it's been shown that it actually wipes out that margin that you might otherwise capture by not paying the commission. And by the way, what I also find is the transaction does not ever go smoothly. The seller has to do a lot more legwork, and they end up probably netting about the same amount anyways. And you typically, as a seller, you're not gonna have that real estate professional to go to with your questions about inspection issues, appraisal issues, all of those common items that your real estate agent can otherwise guide you on. Now you're coming to your attorney, who you're paying an hourly rate, to ask those kinds of questions, and that can add up in and of itself. So I personally have found that sometimes it makes sense if you're experienced in real estate and you think that you can handle the sale on your own. Sure, go for it. I'm not saying it's not possible, but to me, it's much more attractive to use a professional real estate agent, because they bring so much to the table and make things go a lot smoother. So those are my main thoughts and points about, from the legal standpoint, what you're going to want to consider when you do go to sell. And a lot of folks already know this, but you know, when you get to the actual closing, keep in mind the rental is going to be prorated between you and the buyer. So you're not going to be covering a full month of rent or anything like that. Neither will the buyer. That will be prorated on the closing statement. Also, the deposit that you collected, that's something that's going to be credited to the buyer, because now they're going to be in the position to return that to your tenant. So those are some of the common things that you need to look out for. And again, back to the tenant estoppel, that's definitely something that if you're looking to sell the property, you should probably start talking to your tenant, if you intend to keep them in place, to warn them, hey, I'm going to be putting something under your nose. Once I get a buyer in place, it's just going to confirm these items, just to prepare them and make sure they're ready for those discussions, and there aren't any surprises, or God forbid somebody's traveling in Europe for 2 weeks and now we can't get the tenant estoppel we need and the closing is held up. So just some cursory considerations, but of course everybody's situation is unique. So just make sure you get with your attorney and your CPA when you're thinking of selling.
Absolutely. And before we even get into the tax piece of it, or anything that is CPA related, you know, our practice, when I kind of see what our closing coordinator has to deal with just to get ready to pull the documentation, to get the property ready for you know, the closing and everything. And that's when sometimes a lot of the issues get uncovered, like there's a lien, or there's you know, unpaid bills for utilities, or there was an issue with prior owner that never properly got cleared, or now you're in violation of some other land rule from the association, and all of these things. And I think if you don't have somebody to sort of fight on your behalf, and it does start with the real estate agent, because a lot of the agents we work with are just phenomenal. They will be your first point of contact to even try to explain it to you in layman's terms before you even have to talk to an attorney about it, and to try and help figure it out for you. As well as then, of course, you have the attorney who, again, is looking all of this and they've got their ears perked up to any possible issues, versus you just going to a title company. Oftentimes you just show up to the table and there's all sorts of problems that haven't been resolved. So on the legal side, it's a lot of stuff that definitely happens in the back. It's, just like in a restaurant, you hear the clanking of the plates and the falling of the glasses and searing of the food, and it comes out with a beautiful plate, which is your closing package. But to make it get there, it's definitely a whole lot of work and always a whole lot of issues. So definitely getting the proper professional to help you is invaluable. So I wanted to talk on the tax side first about the expenses. So people say, well, I've got expenses that I need to incur to get my property ready for sale. The common question becomes, what do I do with these expenses and where should I deduct them? Should I just tack them on to the closing statement as part of my closing costs, or do I just deduct them as part of my rental expenses? The answer really depends, and I can't stress enough the word depends, because that always is the CPA's answer. But I guess it really depends on your tax rate, because when you're selling a rental property, your gain is going to be considered capital gain, and the capital gain in the current environment anyway is getting a better tax treatment. So the capital gain is taxed at 20%, which is the highest rate. So it can be taxed for as low as 0, it's 15% or 20%, depending on your otherwise total calculation of your total adjusted gross income. So when we're looking at the capital gain of 20%, any deduction that you use on the closing statement to reduce the gain only gives you 20% of a break from taxes. If you are otherwise in the ordinary tax rate of, say, 25 or 30%, say you're a high tax rate taxpayer, then deducting them on the rental statement does give you the ability to reduce your ordinary income, subject to ordinary tax rates, which are higher. So in that particular case, you would be better off taking that expense on as just part of your rental schedule. And sometimes it's the other way. Sometimes you may just be in a lower tax bracket, and then maybe your capital gain may be taxed at a higher rate. So we could, if you're an existing client, it's really easy because we've got all your numbers in our system, so we can run these different scenarios of potential capital gain proceeds, closing costs, expenses that it takes, and kind of let you know what's best before you just go and blindly throw these closing costs on your closing statement. So the idea then is, let's go back to that concept of the capital gain and the rate. So it's very important when people say, oh, well, my gain really shouldn't be this high because, I still owe the bank. And so after I'm done paying the bank, the mortgage, and after I'm done paying all of this, I really don't walk away with as much cash. What you walk away with, which is going to be on the bottom of your closing statement, which is cash due to seller, is not your capital gain. So the calculation is quite different. The calculation for tax purposes is going to be the difference between the proceeds that you're getting from the sale of your rental, less any of the closing costs that come out on the closing statement, less the original cost of the property when you purchased it. And then that is further reduced by the amount of depreciation taken over the years that you've owned it. So you're really looking at your adjusted proceeds, which is proceeds reduced by the closing costs, and you're looking at the cost of the property, which is reduced by the depreciation. The mortgage has nothing to do with that calculation whatsoever. Jackie?
So I'm just curious, if we're looking at the amount that we originally purchased the property for, am I allowed to tack on my expenses and my attorney's fees and everything else that came on that closing statement as well?
Absolutely. Absolutely. And usually the buyer incurs a lot of those costs, because I believe a lot of those stamp taxes and doc fees and stuff like that are actually the buyer's responsibility in many cases. So those are definitely all costs, which is why when we start with a client, when they're buying this property, we always ask for a closing statement. And people say, oh, I don't know where it is. I forgot it. I lost it. Can't you just look up by the county? And when we go to the county records, we can pull up the actual transaction amount. So if you sold your property, if your agreed upon amount was 500,000, that's what's going to show up on there. It's not going to show up 500,000 plus stamp taxes of $6,000 plus. That all only shows up on the closing statement. So it's definitely in your best interest to hold on to that. And particularly if we were not your starting CPA, now you're a new client to us, you had purchased the property several years ago, and maybe it's set up properly on depreciation, maybe not. I want to see your closing statement because, Jackie, you're right on. I want to capture all those closing costs. So the reason why the mortgage does not play a part in a calculation of the capital gain is because you're already deducting the cost of the property that you're paying with, that you're using that mortgage to pay with. So you cannot and deduct the cost of the property and deduct the mortgage that you're paying. That would be double dipping. So the amount of mortgage that's left, maybe you remortgaged it and you refinanced it 10 times, and your mortgage now may be higher, as very common, right, than the original cost of the property. That completely does not affect the calculation of our capital gain, all right? So again, the money you're walking away with on that closing statement is not going to be your capital gain. So please let us calculate that capital gain for you. So closing statement, we got the agreed upon price, we have all our closing costs, we have some closing costs that may be again incurred outside of the closing statement, and then we're looking at the basis of the property. Very important for me to talk about this whole concept of depreciation and how it affects that cost of the property that we're using. So when you're buying a rental property, and I talked about different expenses, and I talked about the depreciation expense, and I did mention that in the last section that we did on the rental. The depreciation expense is essentially you writing off over the years the original cost of purchasing the property, as well as any improvements that you incurred over the years that you had to capitalize and write off over time. And people say very often, I don't want to take depreciation because when I sell, I don't want to reduce my cost basis of the property for the calculation of the gain. I cannot stress enough the understanding that it doesn't matter if you choose not to take depreciation. The way that IRS's rules work is that depreciation is allowed or allowable. And what that means is even if you hadn't taken depreciation, when you show that sale on your tax return, IRS is going to go back and recalculate the gain as if you took the depreciation from the time that this property was considered a rental. Now, they're not very smart to figure out how much, so they may assess something, they may go back to you and force you to calculate it. But the idea is that in that case, you never benefited from the depreciation, not taking the depreciation deduction, and you're getting your cost reduced. And now as a result, you have a capital gain. So please—
You might as well do it right to begin with.
You gotta do it right.
You're gonna get nicked for it anyways.
Absolutely. You're absolutely going to get nicked, and you absolutely have to do it right from the beginning. The depreciation life of the actual property, if it's a residential rental, it's 27.5 years. If it's a house, the portion we allocate to land is not depreciable. So what is really depreciable is only the portion we allocate to the house. And we use some reasonable allocation. We work with you, or we look at the county, the way the county allocates it for tax calculation. Whatever reasonable assessment we use, we figure out how much is allocated to the house, and that starts dripping at 27.5 years. So say you're 10 years into the property, you've taken a nice substantial depreciation deduction, which has benefited you, whether you were able to again claim that loss as you went, or whether that loss has been passive and now that loss is bigger and bigger and bigger and is waiting for you to recognize that gain. And now against the gain on the tax return, you're able to claim that carryover passive rental loss. But the key here is that when you're figuring out the gain, you need to have your proceeds, you need to have your closing costs, you need to have the original cost of the purchase plus the closing costs, less any depreciation taken. And that is going to be the gain from the sale of the property. Now, not to get too technical here, but when we talk about the gain being 20% versus 15%, and people say, well, what if I didn't have any other income and all I had was the gain? Doesn't that mean that it's taxed at zero? No. We got to look at your overall income in the year. We got to look at what tax bracket or what adjusted gross income area you fall into to figure out how much your capital gain is. Again, the easiest way is to run it through the calculation. Please have your CPA do it. If we are your CPA, please let me know. And especially now, I feel like this is what we've been doing for the past 12 months, is figuring out these gains or losses on the property, because people are selling left, right, and center. And there's at least 2 or 3 emails in my inbox every day about, hey, I'm thinking of selling my property, and if I get this much, what's my gain, and so on. So that is definitely an extremely important concept to wrap your head around, as to how to calculate the gain and how to estimate the tax then on that gain, taking into account all of your other factors. And that sort of brings me to the last section of this, and that is, what do we do with this gain and how do I minimize the tax? Because again, now that all the properties are up in value and everybody wants to sell and get their cash out, but all of a sudden people realize, oh, I'm really making a lot of money on the sale of this property. So what can I do to minimize my tax impact? So there's a couple of different things that are happening. The first thing I want to mention is a 1031 exchange. Okay, not to get into any specific rules, because it's a complicated beast. I just wanted to point out some pros and cons of doing a 1031 exchange. So the idea with a 1031 exchange is that you defer that capital gain. So it doesn't go away. You don't get rid of it altogether. You defer it by, instead of selling and getting cash out from your rental, is that you exchange it for another investment property of a similar fair value to your property. So essentially you've deferred that gain into the new property. What happens is that property doesn't necessarily have to be a rental, but it cannot be personal use. It could be an empty lot. It could be a commercial building. It could be another type of investment property that just may be a flip house or something like that. You cannot exchange from an investment property into personal, and vice versa. So it's got to be one investment property to another. The equivalency of the fair value is, again, it just allows you to not have to take any cash out, and then just you're literally putting the same fair value into the new property. The gain stays with that property. When you ultimately dispose of that second property, or if you keep exchanging whatever the final property in that exchange process, when you finally dispose of it, that's when the gain recognition has to take place. So what's been really interesting about doing this analysis for clients in the climate of complete uncertainty of what the tax rates are, is the tax rates right now for capital gains are super low. Like I said, it's 15 or 20%. That's a great estimate to use. Our ordinary tax rates are higher. So there's really no indication of if those capital gain rates are going to go away, if they're going to stay forever, are they going up? Are they going to be equivalent to the ordinary tax rates? We don't really know that. But the general consensus seems to be that the rates are going up. So the idea is, if you defer this capital gain, which you could have paid tax on it today at 20%, when you ultimately go to sell that property and recognize that gain at that time, you have no idea what the rate is going to be then. You also don't have any idea what tax bracket you're going to be in then. So if you have an opportunity to sell the property, cash out, recognize your gain, walk away with the money, pay you 20% tax, and don't break the bank, I would highly suggest to do it. And this is how I've been talking to my clients. The other factor that goes into that analysis is how much gain are we talking about? People immediately say, oh my God, I've got the gain, I got to defer it. Well, no, you don't. If your gain is only 50 grand, please pay your 20%, and you're not even going to be subject to 20% at that level likely anyway. You may be paying 15%. So pay your 15% on 50 grand and move on, because getting into that 1031 exchange is a costly proposition. First of all, you need to hire an intermediary. And what that means is that the cash from the sale of your property cannot touch your hands. If you have cashed out and now you say, oh, great, now I have another property that I want to buy, the cash was already received by you, the transaction is complete, and you now it's considered a sale, and a purchase of something new triggers capital gain. The intermediary makes sure that the cash is sitting in their escrow account waiting for you to purchase a new property. So that's number one. Number two is you have very specific timeline in which you have to identify the new property and you have to close on it. And as you know, in today's day and age, you can be chasing for another investment property and not be able to get it in the right time frame. In the meantime, you're paying substantial fees for all of this to happen. Of course, you're going to have an attorney doing the closing, but again, in addition to the attorney, you've got the intermediary involved. So it can get pretty costly and pretty stressful because you're set in the specific box. It's so that I'm not sure that it really is for everybody. So we got to look at expectation of your income in the future, expectation of what the rates are, the amount of the gain, the amount of the tax on the gain, and your need for cash. You may be selling because you really need the cash. Oftentimes I see if the gain is substantial and people do go ahead with a 1031 exchange and they do need some cash, is that the property that they buy as an exchange property is a little bit less. They can walk away with, let's say, 200,000 of cash, and they just pay tax on that piece of the cash that they've received, essentially of the gain that is triggered. So it still gives them the ability to minimize the gain, cash out, we've seen that happen, and that actually has worked pretty good, again, in situations where you've got some significant gains. So that is definitely something to consider, very specific to each particular situation. So we highly encourage you to really get somebody to do an analysis for you, and to just even to do the gain calculation. Your idea sometimes of calculating the gain may be that you're going to end up with this exorbitant gain, but once we deduct the closing costs and look at the costs and look at the improvements that you've made to this property over the years, your gain may not be as huge as you think. So I think that is definitely one of the options. The other option, and I've got actually, Shelley, I think you're reading my mind. You said, can I spread the gain over several years? That is kind of the last topic that I wanted to cover. You've got the ability to spread that gain over the years if you enter into what's called an installment agreement. In other words, you become the bank. So you hold a note and you receive the proceeds from the sale of the house over years. When you are set up to do that, you recognize the gain ratably as you receive those proceeds. So say you take a 5-year note and you are, getting 500,000, you are going to receive them at 100,000 every year for the next 5 years. You're only going to recognize the 20% of the gain in each of those 5 years and pay tax on it. So installment sale has been also a very popular tool. The risk, of course, is that whoever is your buyer, if they don't, pay you, now you're stuck with the property which you just sold them after some legal fees and so on. And Jackie can tell you some interesting stories about having a proper agreement and a note agreement in place, and particularly if you're selling to family or friends, and how icky that can get. But in some situations it has worked, and it's been a pretty good tool on the tax end. Jackie, I'm sure you want to jump in and say something about this.
Oh gosh, yes. Well, I think yeah, you definitely have to make sure you have the right mortgage and promissory note in place, because when things go sideways, enforcing your rights, getting the property back, all of that is going to hinge on how well written those documents are. And not to mention, there's also some, depending on how many real estate transactions you enter into and how many seller financing transactions you've been a part of, there's certain federal regulations and laws that apply, Dodd-Frank just being one of them. So you definitely, if you're going to participate in any kind of seller financing, just make sure you're talking to your attorney about what may or may not apply to you and what restrictions may apply. And one other thing, Marina, I was just thinking is, I feel like there's quite a few folks that have had vacation rentals down in Florida who are now in the last year or so have really planted their feet there. So depending on how long you're willing to plant your feet there, I think we have our other exemption that somebody could take advantage of from capital gains as well, as long as they're there for 2 out of the last 5 years. Which is a possibility. I've seen some people, considering that, saying, hey, we usually live in Pennsylvania. We've been down here and actually occupying our rental property. So even if it was a rental property, but now it's really your primary residence, that's one way I've heard of people also trying to sidestep the capital gain.
Yeah, absolutely. You can't get rid of all of it, because if the property started as your rental and then converted as the principal residence, you still need to allocate part of that gain to the part of the years of the ownership when it was a rental versus personal. So because the IRS that's exactly what they're trying to prevent, is to say, oh, I'm renting it, now let me move into it for 2 years, sell it, and take the $500,000 exemption. So if it started out as your principal residence and then you converted it to rental, if you sell and you're still within the right time frame, yes, you can get rid of the whole entire gain. But if it started as a rental and then you move into it, you will still have some gain, but yes, you're able to allocate some of a portion of that gain and get rid of it that way. So for sure, that's a great idea, Jackie.
Yeah, I feel like a lot of folks think that it's like this broad sweeping rule, but that's the perfect example of why it's so important to talk to your CPA, because there's so many different exceptions to these rules that there's just no way to keep it all up here. It's a lot. So
my favorite expression, Jackie, the devil is in the details. It always is. You can Google and you can talk to your friends and you can, oh, my friends did it. And at the end of the day, yes, your friends may have done it. And if they never got audited, then nobody really knows. But if you really want to know what the rule is and how to kind of do it the right way and what would work best in my situation, we can tell you. We can run some numbers. Most often, I can tell you in my experience, the numbers are not as scary as people think, just because they may not be aware of all of these other breaks that you can get from just going through the calculation. So I think that is definitely everything that it's perfect timing, Jackie. That definitely brings us to the top of the hour. If anybody wants to hear a little bit more on any of these other subjects relating to the rental property, please send us a message. Send me an email, marina@koontzparking.com. I would be happy to take a look at some of the questions, and if necessary, we may do like a Q&A on the rental, a couple of sessions down the road. We'll just see what some of the questions and some of the concerns are, especially as we're in this crazy year where people are buying and selling and personal and rental. So we're getting all sorts of questions. So we'd be happy to jump back on and do another one of these things. But I think this was a great overview. As I said, the first session was recorded on December 15th. So I'd encourage you to listen to that. And this session concludes the rental property as we wanted to cover it. Thank you everybody so much for attending. We will be back next Tuesday with, I'm sure, another exciting topic, and hope everybody has a great week, and we will talk to you next Tuesday. Thank you so much, Jackie.
Thank you. Have a great week, everyone.